today's episode, we're diving into one of the most misunderstood but surprisingly stable alternative investments, life settlements.
Life settlements aren't flashy, and you won't hear about them on the news or see them hyped on social media. But they've been used by institutional investors for decades to generate consistent, non-correlated returns even during market downturns.
And now, as more platforms begin offering access to accredited and even retail investors, we think it's time to break down how life settlements stack up on our fast-fire investability scale. But first, let's make sure you understand what life settlements actually are. A life settlement is a financial transaction where the owner of a life insurance policy, typically a senior age 65 or older, sells their policy to a third party for a lump sum cash payment. This lump sum is generally greater than the policy's cash surrender value, what they would receive from the insurance company if they canceled the policy, but less than the full death benefit.
The purchaser, often an institutional investor or a life settlement fund, becomes the new policy owner and beneficiary. They take over the responsibility of paying for the premiums and ultimately collect the death benefit when the insured passes away. For investors, this creates a unique asset class that offers stable returns, largely independent of stock market movements, because payouts are based on actuarial estimates rather than market trends.
For the original policyholder, this can be a practical solution providing immediate financial support during retirement or when the policy is no longer needed. And for investors, it becomes a unique asset with a fairly predictable payout timeline.
So who are the actual buyers of these life insurance policies? The answer lies in the specialized industry that most people have never heard of: life settlement companies.
Life settlement companies act as key intermediaries in the transaction. Their job is to identify and acquire eligible life insurance policies, often using sophisticated actuarial and underwriting teams to assess the value and risk of each policy. Once acquired, they either hold these policies on their own balance sheets or group them into diversified investment funds that are offered to institutional and accredited investors. Some firms are vertically integrated, managing everything from sourcing policies to investor reporting. Others operate more like marketplaces or aggregators, connecting sellers with investors. In either case, they play a critical role in making the life settlement market function smoothly and efficiently.
And while this may be your first time hearing about them, many of these companies have been operating for years, mostly under the radar. Most are private, though a few have gone public or work directly with large institutions. You might recognize names such as Coventry Direct or Abacus Life.
Now you might be wondering, if this space is so stable and well established, why haven't more people heard of it?
There are a few reasons. First, life settlements aren't flashy or headline grabbing. You won't see them trending on social media. They're slow, steady, and relatively low drama, which for many investors is exactly what makes them appealing. In a world of hype and volatility, stability can be a very attractive quality.
Second, the barriers to entry have historically been high. You needed to invest large sums or be part of a private fund to get in. But that's starting to change with platforms now offering fractional shares and lower minimums.
And third, let's be honest, there's an emotional hurdle. A lot of people feel weird about investing in someone else's life insurance policy. Even though the seller benefits financially, the idea can make people pretty uncomfortable.
Still, when you zoom out and look at the fundamentals, non-correlated returns, consistent payouts, and growing accessibility, it makes sense why pensions, hedge funds, and family offices have quietly invested billions into this space. So how do life settlements perform on our investability score? Let's break it down. Risk, return, and accessibility. If you're not familiar with our scoring system, click here to see how we use the scoring system to break down multiple types of alternative investments. For return potential, we give it a B, with returns typically in the 8 to 10% range, sometimes higher. These aren't home runs, but they're solid, and they tend to be stable regardless of what the stock market is doing.
For risk profile, we give it a B. You're not betting on market prices, you're betting on actuarial tables. The main risk here is timing. You don't know exactly when the policy will pay out, but the probability of payout is not if, it's when.
This is what sets life settlements apart from traditional investments like stocks or bonds. While the exact timing of the payout is uncertain, the payout itself is contractually guaranteed, as long as the policies are properly underwritten and the portfolio is well diversified.
This asset class can be a little tougher for individual investors to access. Most platforms require accreditation and have minimums in the $50,000 to $100,000 range. And underwriting can lack transparency if you're not investing through a thoroughly vetted platform or fund. So we give life settlements a D for accessibility.
As an example, let's say you invest $100,000 into a life settlement fund that buys hundreds of policies. Your capital is pooled and used to purchase policies and pay premiums. Each year, a percentage of these policies mature and the fund pays out distributions from those death benefits. The key is diversification. No one knows exactly when each person will pass away, but with a large pool, the outcomes start to average out.
That's why most investors use a fund structure. So you're not taking a risk on a single individual's life expectancy, but instead spreading that risk out across multiple policies.
Life settlements are a great fit for investors looking for steady, predictable returns, those who want low correlation to the stock market, and people in higher tax brackets looking for tax-efficient yield.
These are not for investors who need liquidity or want to speculate. These are typically multi-year holds with no way to cash out early.
But if you're building a passive income portfolio and want something stable, this is a powerful addition. To sum it up, here's how life settlements score on the Fast-Fire investability scale. Return potential B, risk profile B, and accessibility D.
If you want to learn more about alternative assets and how they score on our Fast-Fire investability scale, download our free guide at fastfirecapital.com/guide.
And if you want to hear about our upcoming investment opportunities, simply subscribe to our investor newsletter by going to fastfirecapital.com/newsletter. And remember to like this video, subscribe, and join us next time as we explore other alternative investments that the ultra-wealthy use to build and protect their wealth. See you next time.